Hi, this is Optimus Futures and would like to welcome you all to the final installment of the series of videos that we're doing here to introduce the OBIO methodology at large. In all the previous videos, we've talked about little chunks of the OBIO methodology itself, may it be individual indicators that make up the OBIO, or how these indicators work in tandem to present you with really valuable information that you can use to either find good or high probability trades or avoid tricky trading conditions. In this video, we're going to be talking about actually taking trades using OBIO trade signals, whether that be long trades or short trades. We're going to be talking about where you can possibly enter the market, where you can exit the market, where you can place your stop loss, and how you can manage these trades. Before we begin though, I would like to make it very, very clear for all of our viewers that even though we will present you with actual trade ideas and ideas of building a system around the OBIO methodology, it will not be a set in stone method and sort of the only way that you can actually trade the OBIO. There can be, again, because OBIO is so versatile, it's so dynamic and applicable across varied styles of trading, you can always work with the OBIO and use all the information that it provides in a way that complements your own trading style and strategy, and be able to build a system around it that is more comfortable for you and allow you to actually post better results and improved results potentially going into the future using the OBIO. So now that that's out of the way, let's get into the meat of the matter and start looking at potential ways to enter a market using OBIO methodology. In the previous videos, we have talked about the trade triggers that the OBIO presents. That includes the constriction of the bands here, the overbought and oversold bands. We've talked about the implications of divergence, grind and swing divergence on the momentum shift, and of course we've also talked about the sharp rebounds off of these overbought and oversold bands. So we're not going to be going into detail with all these trade triggers all over again. We will actually be looking at the actual entries and exits with the OBIO. So once you've nailed down a location on the chart that you think is strong enough for you to be considering a trade in, because of course the information that the OBIO is presenting you is strong enough, there's probably other information from the candlesticks and price action itself, and maybe that area falls in confluence with a support and resistance area, maybe a trend line, maybe you have other indicators or other aspects of technical analysis that you look at to confirm your trades. And so when all of that lines up and you're actually looking to take a trade, there are really three ways that you can actually use OBIO trade triggers to enter the market. And these range from the most aggressive approach to the least aggressive approach, or the most conservative approach. The most aggressive approach here would be to just take the trade on the initial impact that you see in the market that favors your own directional bias. So let's take an example of that. Let's consider for a moment that you were considering trading this opportunity here, where the market sort of consolidated and tightened up inside of a wedge pattern formation. You saw the constriction of the oversold and the overbought bands, and you see all these dots coming in telling you that the market is frequently trading in either overbought or oversold territory, which basically means that the market is tightening up and is gearing towards a potential breakout. The first candlestick that you see that has a strong impact and closes strongly above or below the pattern itself that you're looking at, that will be your trade trigger. So that of course is an aggressive approach, because you're just taking the trade on an initial impact, not really waiting for further added confirmations from price action or the information from the OBIO indicators themselves to validate and further confirm your trade entry. Another way to look at these aggressive trades is, for example, right here, where the market rapidly accelerates into the oversold bands. This is, of course, the channel violation setup that we're talking about here. So assuming that there may have been ample reasons here for you to believe that this was a good area for you to be taking a long trade in, as soon as the market hits these bands, you would just enter the market right at this point. Of course, in hindsight, we can see that this would have actually worked as a really good trade, and of course the market bounced off of these bands on this occasion. But then this actually brings us to the next extremely important point when talking about taking aggressive trades, and that is the risk to reward ratio. Of course, when you're taking more risk, there's always the potential of getting a higher reward. The benefit to taking these aggressive trades is that you're always going to be very, very close to the actual source or the impact point in the market. That actually yields a better trading result or a better result on the trade itself, because you're actually entering the market timely, and you're basically entering the market early, which means that you will be able to potentially book a lot more profit than you otherwise would if you were waiting for added confirmations, which actually, as we'll see later on in the video, when we talk about these conservative approaches, these can actually result in a lower profit and sometimes even miss trades altogether, because the market will just not stop. It'll just keep shooting in that one direction that you had originally anticipated, but you never got a chance, or the market never presented you with a chance to enter the market because of your conservative approach and because you were looking for so many additional factors to fall in place for you to consider that trade. So once again, depending on the appetite of the trader himself or herself, you may be better suited to either the aggressive approach or the conservative approach. As far as trade management goes for these aggressive trades that you take, it should actually be a lot simpler than taking some of the more conservative trades where you enter the market at a delayed stage because you were waiting for those added confirmations. Sometimes those situations can be a little bit more tricky because you have to ensure that the momentum in the market is still strong enough for you to benefit from price basically moving into your anticipated direction. When you're taking these aggressive trades, the best part about these, like we said, is that you're going to be closer to the source or the impact point in the market. And so that means that you have a greater potential of bagging in or basically benefiting from price moving in your anticipated direction. So for example, let's take a look at the setup here that we were talking about originally, where we're talking about the breakout towards the upside out of this wedge pattern formation and this entire constriction of the overbought and oversold bands. We talked about that an aggressive trade here would be to just maybe take an entry on the close of this first candlestick that closes above the wedge pattern formation. Of course, since you're looking at a breakout situation, you would expect for the market to break into your direction hard. If you had not seen the market actually rapidly move higher above, that may in itself be a very good indication that you need to exit the market, because again, you've taken an aggressive approach. You have not waited for added confirmations from price action itself or OBIO indicators to confirm that this is a valid trade entry. You've taken the aggressive approach, and so that means that if the market does not move in your anticipated direction quickly enough, it may be a good idea for you to either exit the market via a manual close or at least have a very tight stop loss placement to at least keep yourself from getting hurt in case the market actually had rebounded off of these overbought bands here. The other setup that we've been looking at here, we can also look at this. So for example, right where the market actually hits this area, hits the oversold bands here, you could have potentially entered the market via a pending order, sitting pretty much at these bands here, which would have been triggered as the market hit these bands over here. And so you would obviously expect the market to rebound straight away. If the market had not rebounded straight away and the sell side momentum here would have taken the market further down underneath the bands here, even for like a short period of time, it's possibly a good idea to exit the market for a small loss, then be able to really bank on the rebound, even though the market isn't showing signs of potentially rebounding off of these oversold bands. So as you can see, that when you're taking an aggressive approach to taking or trading the OBIO signals, a good part of the actual trade outcome will depend on your ability to react to all of the sort of confirmations that you're going to be witnessing unfold in the market after you take the trade. And so that is, of course, a skill that would possibly be exercised more by a trader who's more seasoned and who's probably spent a lot more time understanding market dynamics and price action and order flow dynamics themselves to be able to work with an aggressive approach consistently. Let's actually look at a situation where using the aggressive approach would have actually not been a very good idea. Let's actually look at this situation, which looks like a decent one for what we're trying to explain here. So let's take a look at this example where the market actually rebounded off of an area of resistance and the overbought band. So if you're looking at this resistance area and you had a pending sell order pretty much at the bands here, this would have been possibly a profitable trade for you because the market obviously rebounded right away. But then what happened here? You can see the market was once again accelerating into the level of resistance, which is kind of the impact that we want to see. But then as soon as the market hits this area of resistance, and it was actually in confluence with the overbought bands as well. In fact, we even had an orange dot sitting right here telling you that the market may potentially have been trading in overbought territory. But really, as soon as the market actually closed above this area of resistance, this area of resistance actually flipped into support. It kind of did over here as well when the market sort of turned around to this area of support. But then eventually, of course, it just continued its way higher. So a blind entry here, a pending order, a short order here to take advantage of the market potentially rebounding for a third time off of this resistance area clearly wouldn't have worked at all. So this is, and these could be the situations where a trader would probably sit back and maybe wonder if it was if it would have been a good idea to actually wait for more added confirmation from the market to support a short trade. Okay, so now let's talk about the second approach here that traders can use to trade OBIO trade signals. The first approach, of course, was the most aggressive in the spectrum. This approach will be more so in the middle. It is not going to be super aggressive, but it's also not super conservative. This is the approach where the trader will actually consider trades only upon seeing price action confirmation. So we're actually looking for bullish engulfing patterns or bearish engulfing patterns or bullish or bearish pin bars or other candlestick patterns that a lot of technical traders watch. We're looking for these price action confirmations that appear at our areas of interest. So around and near these bands, overbought or oversold bands, especially when these bands are constricted. So we're looking at a breakout play, or maybe when the market is rapidly dropping into these overbought or oversold channels here for a potential channel violation trade. So an example right here is going to be this one, where we have the market actually rapidly dropping into the oversold bands. And of course, the market does rebound here, which you would typically expect when the market is, especially when it's more sideways compared to when it's trending. So it does rebound, but then we also have the added confirmation from the bullish engulfing pattern, which again implies that there's strong bullish momentum entering into the market. And of course, looking at the OBIO indicators here, we see why that momentum came in here. And so taking a trade off of a bullish engulfing pattern as a channel violation trade is just a way to further validate your trade setups and potentially look for higher probability trade setups. Now, of course, this means there's going to be multiple situations where you're going to be looking at a very important location in the market in terms of maybe that location having a mix of other factors, including support and resistance levels or trend lines or round numbers, and you will just not have a price action confirmation to trade off of. So those are going to be the situations where you might actually just be able to just end up missing the trade opportunity altogether, where price still does what it's supposed to do and what you anticipated that it would do, but you just won't be able to take a trade there. So you're probably going to be taking fewer trades, but the trades that you do take are possibly going to be of higher quality and a higher grade compared to the more aggressive approach. Now, the other sort of a disadvantage with using this strategy would, of course, be that since you're waiting for a price action confirmation, you cannot actually enter at the source of the impact point in the market in itself for the most part. Now, for example, if we had say a bullish pin bar with a wick protruding to the downside underneath these bands here and a close pretty much at the bands, and so if you had taken a trade at the close of that bullish pin bar, you would still have been pretty much at the source or at the impact point in the market. But in this situation, as you can see, since we waited for a bullish engulfing pattern, we would possibly only be entering the market at least at the close of this bar, which would mean up right here instead of down at the source. So we're essentially missing out on all of these ticks here and all of this movement here that's actually still going in our direction or in our anticipated direction. But still, in this setup at least, we know that there is still a lot of space for the market to sort of move into, and so of course it just goes all the way up to these oversold bands. And again, no surprise that the market actually did find resistance here. We had the overbought bands, we had a cluster of yellow dots here, and of course we had an area of resistance. So no surprise why the market bounced there. But it would still have been at least a good sizable trade in that the market did rapidly move to where we would have initially anticipated it to go to. As far as trade management is concerned, the second approach, it actually becomes really simple when you understand that you're actually taking a price action confirmation trade. You're actually trading price action itself. So once you understand that you're really just trading a bullish engulfing pattern here, it becomes simple because now you can just treat it as a bullish engulfing trade. So if you're taking a trade right at the close of this bullish engulfing pattern, typically technical traders who are trading price action candlestick patterns, they'll just usually place a stop loss at the opposite end of the pattern itself that they're trading. So in this case, the stop loss would possibly go just a few ticks underneath the low of this bullish engulfing pattern. And as far as trade management itself is concerned, of course, you can just use either former highs or lows, or of course, you can just use OBIO factors in here as well to manage your trades. So keeping an eye out for bullish and bearish divergence, keeping an eye out for the areas that where the overbought and oversold channels fall, and of course, keeping an eye out for these yellow, orange, and red dots as they appear, and the overall larger time frame momentum and trends. All of that can really help you manage your trade as it develops. Okay, so that said, let's actually look at the final approach here that traders can use to take OBIO signals. This is going to be the least aggressive or the most conservative approach of them all. This is going to be the situation that will involve waiting for the break of the middle band itself that you'll see runs for the most part between the overbought and the oversold bands here. In our previous videos, we've talked about the role of the middle band itself and how when the market is actually displaying strong momentum. So for example, right here, we have a strong looking uptrend. You'll notice how the market tends to stay above the middle band and is going to frequently use the middle band as a source of support to continue launching further towards the upside. As a sharp contrast to that, of course, when the market is consolidating and is not very decisive, you'll notice that the middle band sort of acts as a pivot for the entire period of consolidation. The market will frequently either be testing it or breaking it or pulling back to it again and again until it obviously finds momentum and is able to consistently either stay above the band or below the band. So what we're doing here is we're using the same methodology from a trade management perspective to actually time our trades a little bit better or add more filters and confirmations to the trade setup that we're actually considering. So let's take a look at a few examples here. Let's look at this first example where the market actually rebounds off of the overbought bands. Of course, this is an area of resistance as well. We actually also had a yellow dot that you can see right here. That itself we know isn't going to be a very strong indication, but of course we had a very strong area of resistance here. And of course the market rebounded off of the overbought bands over here. But as soon as the market rebounded, instead of actually taking the most aggressive approach and taking a blind short entry over here, which actually would have been a very, very risky trade, especially given this large looking bullish engulfing pattern that occurred not too long ago, or even for that matter, waiting for price action confirmation, what we're going to do in this case, where we're using the least aggressive approach, is to just wait for the market to actually close strongly below the middle band here. You can see that technically this is where the market had closed underneath the band, but this wasn't an authoritative or a strong looking close. It was just a drag underneath the middle band, and then the market pulled back and actually found resistance at this middle band. This is exactly the kind of dynamics that we're looking for when we're looking for strong moves that have good momentum to them. As discussed, when, for example, say the market is trending down, it will usually tend to stay underneath the middle band and actually frequently use it as a source of resistance. Only when we had actually seen that happen in the market would we actually take a trade towards the downside. And in this case, you can see that a short taken here after we had seen evidence of the market finding resistance at the middle band would actually still have been a very fruitful trade, and we would still would have benefited from the market dropping extremely rapidly towards the downside, allowing us to make some good gains on this trade. Let's look at another example here of what we just discussed. Let's take a look at this pattern over here, and of course this constriction of the overbought and oversold bands. Of course, the market is tightening up here and gearing towards an impending breakout. Right here where we actually have the breakout, you'll notice that we not only have a close underneath the pattern itself, and we also actually have a break and a close underneath the middle band itself. So when we have the middle band break as a confirmation on our trade setups, it gives us the added advantage and benefit of actually using the middle band itself as a trade management source. So what we can do here is that we can actually trail our stop manually as the along the middle band here, because the anticipation, as we discussed here, is going to be that if the momentum here stays strong and the market continues in this bearish trend here, it should continue to find resistance off the middle band. Right at the point where it actually fails to find resistance at the band is where you would technically want to exit the market. So it actually makes for a very objective trade management plan where you really don't have to think a whole lot about where to exit the market or where to actually take your profit. So this is actually the biggest benefit of using the middle band. Of course, the flip side to it, or the worst part about using the middle band break as a source of trade confirmation, is that you'll probably on frequent occasions you'll be either missing the trades altogether because you never find that perfect chemistry, that perfect market dynamics that you're looking for around the middle band, or for that matter, you'll just never find that perfect close underneath or above the middle band, as the case may be, for you to actually consider taking a trade. So for example, look at this move right here. We had a very sharp move as a market as part of a channel violation setup, where the market rebounded off of these overbought bands here. You'll notice that right around here, where the market actually rebounded, right around here where the market broke underneath the middle band, we never actually had a confirmation or price action in itself that would have allowed us to enter the market. You'll see that this candlestick here actually closed on the middle band itself, and then the next candle really just shot right down and closed so far or so further away from the middle band itself that taking an entry here would definitely be categorized as a very late entry into the market, and you're obviously trading perilously close to the oversold band here, and you're really not giving the trade ample space to run at all. And of course, you can see that in hindsight, if you did take a trade here, it would have run straight into this area of support created by the oversold band here. And of course, if you stretch it further back, this is actually an area of former resistance as well that flipped into support. So these are all the things that you really need to consider when you're using the least aggressive approach, which is using the middle band break as a source of your trade entries. You need to understand that there will be several situations and several circumstances in the market where you will not be able to enter the trade at all, even though you've identified the location as a strong one, and you understand that a trade taken at that location is going to be a high probability trade setup. At this stage, it is important for us to let our viewers understand that even though we've talked about 3 distinct ways that you can use the OBIO signals to actually take entries in the market or exit the market, these are not the only 3 ways that you can actually use to trade the OBIO. We've talked about this frequently in our past videos as well, that the OBIO itself is a highly dynamic and versatile. It's really just a tool that you can use on top of your existing methodology as well to make it better. Or you may not use any of the trade signals themselves that the OBIO generates, but use the broader knowledge that it provides you in just making better trading decisions and just trying to understand what the market is trying to do at any given moment in time. May it be during a period of consolidation or during a period where it's where the market is potentially grading up for a breakout, or during times when the market is actually trending heavily. So that essentially wraps up our series of videos here that we were doing to introduce the OBIO methodology, and would like to thank you for your time. We hope the OBIO methodology and the information that we provided to you about the OBIO methodology will help you potentially achieve better trading results going into the future.